You're making solid money, but it never quite feels like enough. Your paycheck arrives, bills get paid, and somehow you're still stressed about an unexpected car repair or that dental work your insurance doesn't cover. The frustrating part is knowing the math should work. $80,000, $100,000, even $130,000 in annual income should feel stable. Most people don't realize they're in a trap designed by the tax code itself, and it costs them thousands every year without them even knowing it's happening. What if I told you there's a quiet, legal way to keep an extra $8,400 in your pocket every single year, and the IRS actually approves of it? In a minute, I'll show you exactly how this works and who it's designed for. But first, let me explain why you're feeling broke despite earning decent money. If you've ever wondered why self-employed people, consultants, or small business owners seem to stress differently about money than W-2 employees, this is the reason. The self-employment tax system was built in a way that creates a permanent financial leak for anyone working for themselves. When you're a sole proprietor or single-member LLC, the system requires you to pay something called self-employment tax on every single dollar you earn. Most people think self-employment tax is just another word for regular income tax, but it's actually completely separate and significantly more expensive. Here's where it gets real. Self-employment tax is 153% of your net income. That's 124% that goes to Social Security and 29% that goes to Medicare. And you pay the full amount as both the employer and employee. Compare that to a W-2 employee where the employer covers half of those taxes. The employee only sees the Medicare and Social Security come out of their paycheck. A self-employed person earning $130,000 would pay roughly $18,368 in self-employment taxes annually. That means for every dollar you earn, nearly 15 cents is automatically reserved for taxes before you even think about federal or state income taxes. On top of that, now the government does give you a deduction for half of your self-employment tax, but the damage is already done. You've lost access to that cash, and the deduction only helps when you file your return months later. This is the invisible leak in the self-employed person's budget, and it happens year after year, compounding into tens of thousands of dollars over a working lifetime. Most employed people earning a similar income actually keep more take-home cash than self-employed people earning the exact same gross amount. Most people miss this entirely. That's the trap you're probably in right now if you're self-employed. But here's the strange part of the tax code. There's a legal structure that lets you keep that money, and the IRS basically shrugs and allows it because of how the law was written. It involves converting your business to what's called an S-corporation for tax purposes, and the result is dramatic. Instead of paying 153% on all your income, you split your income into two buckets. One bucket gets hit with payroll taxes, and the other bucket doesn't. This isn't creative accounting or a loophole. It's the literal intention of how S-corporations work under the tax code. Most financial advisors don't talk about this because they don't work with enough self-employed clients. And most self-employed people don't know it exists because their accountant hasn't suggested it. Probably because the accountant is overworked and hasn't done the math. Let me show you exactly how the math works on a real scenario. Imagine you have $130,000 in net self-employment income for the year. 18,368 times 130,000 equals roughly $18,368 total self-employment tax. As a sole proprietor, that $130,000 would trigger about $18,368 in self-employment taxes. After the deduction, you're still out roughly $9, $184 in actual cash. That could have gone to your family. Now imagine the same $130,000 of income, but structured as an S-corporation instead. You decide to pay yourself a W-2 salary of $65,000. Half of your total income. That W-2 salary does trigger payroll taxes. But here's the key difference: the Social Security portion of payroll tax only applies up to the 2026 wage base of $184,500. And your $65,000 salary is well below that. So on that $65,000 W-2 salary, you'd pay roughly $65,000 times 153% equals $9,945 in payroll taxes. $9,945 in payroll taxes. Total. The remaining $65,000 comes to you as a business distribution, which carries zero self-employment tax. That saves you $18,368 minus $9,945 equals $8,423 per year in taxes. Now, the government didn't accidentally create this loophole. It's actually the intended design of how corporation income flows through to owners. But there's a critical catch that most people skip over. And this is where the IRS gets serious. But the last part changes everything about how aggressive you can be with this strategy. The IRS has a specific requirement called reasonable compensation, and they watch this requirement like a hawk because too many people tried to abuse it. The reasonable compensation rule says that if you're an officer of an S-corporation, the wages you pay yourself must be reasonable for the services you actually perform. This is not a gray area. The IRS has taken S-corporation owners to court over this specific issue multiple times, and they won every case. There was a famous case involving an attorney who set up an S-corporation and paid himself only $24,000 in annual salary, while taking $200,000 in distributions from the same business. The IRS challenged it. The attorney argued that distributions shouldn't be taxed as wages, and the court sided completely with the IRS. The attorney had to pay employment taxes on the distributions plus penalties and interest. This is the reason most accountants are conservative about S-Corp elections. They've either seen or heard about cases where aggressive compensation strategies took catastrophically wrong turns. This is where it gets real. The IRS uses specific factors to evaluate if your salary is reasonable, and understanding these factors is what separates a defensible strategy from an audit waiting to happen. Revenue Ruling 7444 is the official guidance, and it includes factors like your training and experience, the duties you actually perform, the hours you work, what comparable businesses pay for similar roles, and your business profitability. The practical result is that the IRS expects you to pay yourself somewhere between 40 and 60% of your net business income as W-2 salary, depending on the specifics of your situation. That means for a $130,000 income, somewhere between $52,000 and $78,000 should be your W-2 salary. The remaining amount can be taken as distribution on. The conservative approach is 60% salary and 40% distributions. This is the safest bet and rarely triggers IRS questions. The moderate approach is $5,050, which is reasonable and defensible if you keep good documentation. The aggressive approach is 40% salary and 60% distributions. This technically might be defensible for a certain type of business owner, but it substantially increases audit risk. Most people interested in S-Corps end up targeting the 5,050 split because it provides meaningful tax savings while keeping the salary reasonably defensible. Now, before you rush out and elect S-Corporation status tomorrow, you need to understand the costs and the requirements because this strategy doesn't make sense for everyone. The most obvious cost is the complexity and administrative burden. Once you elect S-Corporation status, you're running actual payroll, which means quarterly payroll tax filings, W-2 forms, and a separate corporate tax return. Payroll processing typically costs between $1,200 and $2,400 per year, depending on whether you do it yourself or use software or a service. The tax preparation for an S-Corporation return is more complex than a sole proprietor return, so your accountant fees probably increase by $800 to $2,000 annually. Some states have additional fees or franchise taxes. California, for example, charges an $800 minimum franchise tax on S-Corps, which immediately reduces your federal savings in that state. Most people spend between $2,000 and $5,200 annually, just on the administrative costs of running an S-Corporation. This means the break-even point matters significantly. If you're earning $50,000 in self-employment income, the federal tax savings probably don't justify the costs. You'd actually lose money by electing S-Corporation status. At $80,000, the math starts to work. Your savings exceed your costs by a meaningful margin. At $130,000 or higher, the strategy becomes obviously valuable. Most people miss this entirely. It's not about whether you can technically elect S-Corp status, it's about whether the tax savings exceed the administrative costs. If you're inconsistent with your income, some years you earn $40,000, some years $120,000. An S-Corp election might not make sense because you're locked into the administrative costs regardless of income level. The IRS requires you to maintain S-Corporation status for at least 5 years before you can voluntarily revoke it, which means this is a medium-term commitment, not something you do on a whim. This is the part people overlook. If your income drops significantly, you're still paying all the administrative costs, but you're not getting the tax savings anymore. The practical approach is to only elect S-Corporation status if you have fairly stable income that you expect to maintain at $60,000 or higher for the next several years. If you're in your first year of business or you have highly variable income, it usually makes sense to wait until you have more predictable earning. Now let's talk about the actual mechanics of how you make this happen. Because the process is straightforward, but the details matter. First, you need to have a business entity, either an LLC or a corporation registered with your state. If you don't have one yet, you'll file articles of organization with your state, which usually costs $50 to $500 depending on the state. Once your entity exists, you file Form 2553 with the IRS to elect S-Corporation tax status. This form has a specific deadline. You need to file it within 2 months and 15 days of the beginning of your tax year, or within 2 months and 15 days of when you actually formed your business. For a calendar year business, that means March 15th is the deadline if you want S-Corporation status for that calendar year. If you miss the deadline, there's a late election relief process, but it requires explanation and documentation, so it's much better to file on time. Once your S-Corporation election is approved by the IRS, you set up actual payroll. This means obtaining an EIN if you don't already have one, registering for state unemployment taxes, and choosing a payroll system or service. Most people use software like Gusto, QuickBooks Payroll, or ADP, which handles the withholdings and tax filings automatically. You'll need to run payroll at least quarterly, though monthly is more common and less likely to trigger IRS questions about compliance. Each quarter, you file Form 941, which is the federal payroll tax return showing how much you withheld, paid, and owe. At the end of the year, you file your business income tax return on Form 1120S, which is different from a sole proprietor's return. The 1120S shows all your business income and expenses, and then it flows a Schedule K-1 to you personally, which you report on your individual tax return. You also need to file Form W-2 for yourself as an employee, even though you're the owner. This is a critical detail that many people get wrong. You cannot skip the W-2 and claim all income as distributions because that defeats the entire reasonable compensation requirements. The W-2 documents that you paid yourself a legitimate wage for your work in the business. This is where it gets expensive. One missed filing or incorrect filing can trigger penalties and IRS interest, which can quickly erase the savings you were supposed to gain from the S-Corp election. This is why most serious S-Corporation owners work with a CPA who specializes in this area. The CPA isn't just handling tax preparation. They're helping you navigate the compliance requirements and ensuring you stay on the IRS's good side throughout the year. Most people think about the tax savings number and forget to budget for the professional help, which is false economy because the professional help is often what prevents expensive mistake. Now, let me walk through the most common mistakes I see people make with S-Corporations, because understanding these mistakes is your best insurance against making them yourself. Mistake number 1 is paying yourself too little salary in an attempt to maximize distribution. This is the zeroing out strategy that the IRS absolutely watches for. You can pay yourself $20,000 in salary when you're taking home $150,000 total and justify it by saying the rest is distributions. That math doesn't pass any reasonable compensation test, and it's a neon sign for an audit. Mistake number 2 is not running actual payroll. Some people try to shortcut the system by just paying themselves via owner's draw and calling it a salary. Or they run payroll sporadically without proper documentation. The IRS can see if you're not filing quarterly 941 returns. And if you're not, they reclassify your distributions as wages anyway, which defeats the entire purpose and adds penalties on top. Mistake number 3 is electing S-Corporation status too early. If you just started your business and income is unpredictable, you're committing to 5 years of administrative costs and complexity when the tax savings might not materialize. You want to wait until you have at least 1 year of consistent, predictable income data before you make this election. Mistake number 4 is mixing personal and business money without clean separation. If you're paying personal expenses from the business account, the entity structure becomes harder to defend if audited. Courts can pierce the corporate veil and disallow the S-Corporation protection if you don't maintain proper separation between personal and business finances. Mistake number 5, and this is a big one, is not keeping documentation to support your reasonable compensation claim. If the IRS ever questions your salary, you need to be able to show documentation like industry salary surveys, hours worked, your qualifications, comparable business owner salaries, and any compensation agreements you have with yourself. Without documentation, you're just making an argument. With documentation, you have a defensible position. Most people miss this. The administrative burden isn't just about filing forms. It's about maintaining records that prove your reasonableness claim. Now, here's where it gets important. If you live in certain states, the S-Corporation strategy might actually save you less money than you think, or in some cases might not make sense at all. California has a mandatory $800 annual franchise tax on S-Corporations, which comes off the top of your federal savings immediately. New York charges based on income levels and has an additional commuter tax that can further reduce your benefit. Texas has no state income tax, which means S-Corp elections provide even more savings in that state. Most other states treat S-corporations similarly to the federal treatment, so the savings are similar. The practical move is to research your specific state's treatment before making the election, because state taxes can materially impact whether this strategy makes sense for you. Most people just focus on federal tax savings, and then get surprised in April when they discover their state has an $800 fee they didn't anticipate. All right, let me summarize the core insight here, because this is where everything clicks into place. The reason self-employed people feel broke despite earning decent money is because of the self-employment tax system, which takes a chunk that W-2 employees don't experience. The S-corporation election strategy works because it separates your income into two categories, one that triggers payroll taxes and one that doesn't. The critical requirement is reasonable compensation, which means you can just minimize your salary. You have to genuinely justify what you're paying yourself based on your role, experience, and what comparable people earn. The strategy only makes financial sense if your income is stable, consistent, and above roughly $60, $000.80, $000 annually. Because below that, administrative costs outweigh the tax savings. The implementation involves filing Form 2553, setting up payroll, running quarterly filings, and working with a CPA who understands the nuances. The biggest risk isn't from the IRS trying to deny your S-corporation status. It's from you making a compensation mistake that triggers an audit and penalty. 3 critical takeaways here. First, self-employment tax savings come from income splitting, not from tax evasion. Second, reasonable compensation is the IRS's actual enforcement point, and it's worth taking seriously. Third, the math only works above a specific income threshold where savings exceed administrative costs. If you're self-employed and earning consistent income above $80,000 annually, it's worth running the numbers with a qualified CPA to see if C-corporation status makes sense for your specific situation.